Everyone's been celebrating rate drops and thinking 2026 is going to be a smooth sailing for mortgages. But CMHC just released their data that tells a very different story. And if you're renewing your mortgage this year or thinking about your mortgage strategy, what I'm about to share with you could change everything. I'm going to walk you through exactly what's happening with variable rates and why fixed rates are climbing, and what this means for your specific situation, whether you're in Toronto, Calgary, Halifax, or anywhere in between. This isn't theory, this is what actually is happening right now in 2026. Before we dive in, I'm Dion Williams from Williams Mortgage. I work with Canadians all across the country, helping homeowners get mortgage free faster. If you want to chat, click the link below and book straight into my calendar. And while you're at it, hit that subscribe button so you don't miss any updates. All right, let's talk about what's actually happening and in the market right now. Because mortgage rates don't just randomly move. They're tied to what's happening in our economy. CMHC is forecasting slow growth in 2026. We're dealing with trade uncertainty, especially with what's happening south of the border, and that's making businesses hesitant to invest. On top of that, we're seeing slower population growth than we had in previous years. A soft job market and income growth, that's, let's just say, modest. What does this mean for you? Households are being more careful with spending. People are tightening their belts, and that directly impacts housing demand. But here's what's interesting. The federal government is pumping significant money into infrastructure housing and clean energy projects. These take time to kick in, but they're designed to boost the economy long term. So we've got this push pull happening. Economic headwinds on one side, government stimulus on the other. And right now, in the middle of all of this, your mortgage. This is what you really need to understand, because in 2026, it's shaping up to be a tale of two different mortgage types. Let's start with variable. If you got a variable rate mortgage, you've probably enjoyed watching your rate come down over the past couple of years. The Bank of Canada has dropped rates to stimulate the economy, and you felt that directly in your payments. Here's what CMHC is saying: those variable rates should stay relatively stable through the first half of 2026. That's good news. But, and this is an important but, be prepared for a shift. As the economy finds footing, the Bank of Canada is going to look at normalizing policy. What does that mean? It means we'll likely see variable rates start to climb again in mid 2026. Now, fixed rates, that's a different story entirely. CMHC is forecasting that fixed rates are going to rise in 2026. And here's why: it comes down to government bond yields. With all the increased government spending I mentioned, there's more borrowing happening. That pushes up yields on long term bonds. And those bond yields, they're the foundation of fixed mortgage rates. So here's your takeaway: the rate environment is shifting. That stability we've seen in variable rates might be temporary. Fixed rates are pointing up. If you're finding this valuable, do me a favor, hit that subscribe button right now. I break down this kind of market intel every week so you can make smart decisions with your mortgage. All right, let's keep going. Now, let's talk about what's actually happening on the ground with home sales and prices, because this is where it gets really interesting and really regional. Nationally, home sales are expected to stay below historically 10-year average. But we're seeing a temporary pickup in 2026, especially in Ontario and BC. But this boom, it's more like a release valve, pent up demand after a few really slow years. When it comes to price, the national average is expected to stabilize with some modest gains. But the real story, it's all about where you live. Ontario's actually a buyer's market in some areas. In fact, it's the only region where CMHC expects the average price to actually decline in 2026. This is especially true in the pricier urban centers like the GTA. There's high inventory of homes for sale, and that's putting downward pressure on prices. If you're in Toronto and you've been waiting, this might be your window. British Columbia, prices are expected to see some growth in 2026. Part of this is because a lot of newly completed higher priced condos are hitting the market and lifting the average. The resale market is showing signs of life, but it's still not back to historical averages. The prairies, this is a bit of a bright spot. Alberta, Saskatchewan, Manitoba, these markets are performing well. Sales and constructions are above historical averages. We're looking at modest price gains, supported by relatively strong economic conditions. If you're in Canada, in Calgary or Edmonton, your market looks completely different than Toronto. Nova Scotia, specifically Halifax, the market is shifting rapidly. Population driven growth we saw recently is more at a balanced pace. CMHC is forecasting that both housing starts and prices will remain stable, supported by your local strong labor market. See what I mean? The story in Toronto is not the same story in Calgary. It's not the same story in Halifax. You need to understand your specific market. What about new homes? If you've been waiting for a flood of new construction to ease prices, you might need to adjust your expectations. CMHC projects that new home constructions will actually decline through 2026. Developers are facing high construction costs and weaker demand. Condo starts, especially in Toronto, are weaker than expected. Pre-construction sales have hit multi-decade highs. The one bright spot, purpose-built rentals. Government incentives and strong demand are keeping those projects moving. And this is having a real impact on the rental market. For the first time in a while, rental markets across the country are moving toward balance. A wave of new rental supply is coming online. That means higher vacancy rates and slower rental growth. If you're renting right now, this gives you more breathing room and more flexibility. So let's bring this all together. What does this mean for your mortgage strategy in 2026? If you're on a variable rate, enjoy the stability for now, but start planning for rates to climb mid year. This might be the time to lock in if you want certainty. If you're looking at fixed rates, understand they're rising. The window for lower fixed rates is closing. If you're renewing soon, don't wait. If you're buying, your strategy depends entirely on your region. Toronto, you might have negotiating power. Calgary, it's a different game. Halifax, it's stable but balanced. And if your goal is to get mortgage free faster, which is what I help people with every day, this environment actually creates opportunities. When rates shift, when the market rebalances, that's when smart people restructuring can save you thousands of years off your mortgage. Look, 2026 is a market in transition. It's the end of the ultra low rates, which is behind us. We're seeing a more balanced market, but with significant regional differences. Navigating this requires a clear strategy and up to date information. So, if this helped or you found value in this, please hit that like button and subscribe button. And while you're at it, hit that little bell. And if you do want to book a call with me to see how we can restructure your payments, see if we can pay off some debt, or just look at your scenario in general, click the link below in the description and you can book an appointment with me directly in my calendar and we'll meet on a Google Meets. Thank you so much for watching and we'll see you in the next one.